Welcome, everybody, to this webinar, Technical Analysis, Part 4 of 5. And back with us is Patrick Ceresna, continuing on this journey of technical analysis. I'm going to pass it on to you, Patrick. Go ahead.
Oh, thank you very much, Ryan, and hello, everyone, and thanks for joining us for Part 4. As you can see, we finally got to technical indicators. A lot of beginners that get introduced to technical analysis often are drawn to these indicators thinking that that is what technical analysis is. And of course, indicators are part of technical analysis, but I look at them as a nice complementary tool rather than the foundation of technical analysis. But this is where we're going to actually really try to understand what they are and how you can use them to complement your existing trading. And so my name is Patrick Ceresna from Big Picture Trading. You can follow me on Twitter at Patrick Ceresna. And as well, you can listen to our free podcast at macrovoices.com or listen to our Market Huddle show, which is available as a podcast as well as on YouTube. So please do register for that. It's a great free content on the internet. So let's take a dive into what I intend on covering. We're going to cover 4 indicators. Obviously, there's probably even 100+ indicators out there. These are the most common ones, and they're easiest to explain why there's value in many of you utilizing them as a tool. And so we're going to cover the MACD, we're going to cover relative strength, we're going to cover stochastics, and we're going to talk about the momentum indicator. So let's just jump right into it and take a look. So now each one of these presentations, I start off with the one slide, why technical analysis, and I think it's really important to touch upon it. I always say technical analysis is important because fundamentals only offer the understanding of value. And a perfect example is the time when we were recording this, and even though you may be listening to this at a much different time, we were recording this during the coronavirus market crashes. And you could have done all of the fundamental research you wanted to prior to that. But when the technical selling, the liquidity of the market shifted, it didn't matter what the fundamental value of the company was when the selling began. And this is where bridging the two together, I look at them as complementary. I love to technically trade fundamentally good things. You never want to discard fundamentals. It's just that fundamentals are anchored off of balance sheet value, and technicals are about the flow of orders and sentiment and the behavior of investors in and out, as the psychology, like when the coronavirus, for instance, is hitting here, the psychology of everyone just shifts and everyone feels that they need to sell. And it just is a psychological turn and has a lot to do with liquidity and far less to do with what the companies are actually really worth. So let's just jump right into it. Let's talk about the MACD. And this is the Moving Average Convergence Divergence. And so what is this indicator and why should you care? And so what this does is it actually measures the difference between two moving averages. Now, before in our prior part 3, we talked about moving averages. We talked about this idea of these moving averages going higher and lower and how we can use them to make investment and trading decisions. But now what we're trying to do is measure momentum. And therefore, knowing that a short-term moving average would be far more responsive than a longer-term moving average. When a price starts to move in a rapid way in one direction or another, as these moving averages are diverging and then subsequently reconverging, it is measuring it in an oscillator and puts it on as an indicator for us to be able to kind of get a pulse on actually how the price is moving through this oscillator. And so here's just a snapshot image of what if you just put on a MACD onto your screen would look like. And it's a little intimidating. A lot of people initially are looking at it as a whole bunch of squiggles and different colors and what's going on. So let's actually break it down, because there's 2 very important components of a MACD indicator that you want to grasp. So the first thing that you want to grasp is the histogram. The histogram is the bar charts on there, which are the actual difference between the moving averages themselves. And they're a very good tool for observing momentum, as well as for identifying periods where the price action continues to progress while is doing so on declining momentum. That's called divergence. And so you'll hear a lot of technicians talk about divergent markets. And what that is saying is that the price might be moving one way, but the momentum is already shifting. And that is just saying that the bulls or the bears that were in control of the trend up to this moment may be losing that buying momentum or the selling momentum in there. And so it's usually the first indication of a potential reversal of trend. We don't use that alone to make the market call, but it is something that we can observe. And so notice here I isolated simply the histograms itself, and that's the green and red lines down below. And what I was observing here is I noticed that very early on in the rally on the green, the momentum was extraordinary steep and quick, and that the histograms quickly shot up higher in a very rapid fashion. And even though for the progressive month throughout that month of August in this chart, that the stock continued to progress higher and higher, the momentum actually started to wane and diverged. Now that's not a blatant example. It's the second one to the right that you can truly identify a loss of momentum. What you can observe is that in the initial burst higher in the month of December, you had that burst higher where the candles are ripping higher and the momentum surged to the top side of that. Then, even though the market kept going higher and kept going higher throughout the next 2, 3, 4 weeks, the momentum actually completely slowed to the point that actually momentum at the top peak was pretty much flatlined at zero. Isn't that interesting, right? What it's trying to observe is the fact that even though the stock, when you're looking at your quote screen and looking at what the price is, and you saw it at $127, next day it's at $128, you just by looking at the number say it's going up, and therefore that means it's good. But what this indicator starts to do is demonstrate when a loss of momentum may in fact be signaling that the move is very mature. And what I do also want to emphasize with this is that just because a move is mature and momentum is diverging doesn't automatically mean it's going to crash on the other side. Sometimes, very similar to what you see on the farthest part of the right part of the chart, is that after that momentum surge and the divergence, the price just more or less chopped sideways. It wasn't that it had to have some big extraordinary sell-off that was an epic shorting opportunity, but rather simply identifying that the bull cycle that was in place has now potentially begun a consolidation. And so don't overread that it has to be a short, but rather it's more of an identification that the further upside may be limited. Now, that's not the signal line, though, that traders look for. So traders often will turn to the histogram as their resource for looking at divergent price action or momentum. But it's the actual MACD crossover lines that often traders turn to create buy and sell signals. And so bullish and bearish moving average crossovers on the MACD line are used as buy or sell signals. Now, it is usually a very good exercise to have a secondary technical analysis technique confirming the signal. Because what we have to step back and think about, actually I'm going to just go off on a little bit of a tangent for a moment, because this is speaking to all indicators. Indicators as a broad measure are just mathematical equations that are interpreting price, time, and volume. And so every variant of an indicator is just an interpretation of actually the same data, simply computed and expressed on the chart, oscillating in some different way, measuring some different variable of it. The way I like to describe it is it's a lot like, let's say, being in a single prop engine plane and you're the pilot. Well, you're a pilot and you have all of this cockpit gauges in front of you. And all these gauges are giving you different information about flying the plane. You're not going to choose as a pilot to take off and land the plane based solely on one of the gauges on your dashboard. You're going to confirm things. You're going to look out the window. You're going to see how high you can see you're off the ground. You're going to feel whether the plane is leveled. You're going to look at another gauge that gives you some sort of information to verify that. The point in the same, using that analogy, you don't want to ever trust one indicator solely. What you're looking for is the indicators giving you an action point, and then you as a trader are looking for, is this actually verified? Can I actually justify taking an action in the market based upon this? And so what we can now do is show that MACD line. It's just mathematically showing and expressing in an oscillator the moving average convergence divergence. Now, what we do is that when you have that MACD line, how do you get it to give you a buy and sell signal? Just the way in part 3 of this technical analysis program we were using a moving average. In the same manner here, we're going to overlay a moving average on top of the MACD line, so it looks like this. And so what you have is the main MACD line in that brownish color, and then you have the black line, which is a 9-period signal line, or like a lagging 9-period moving average on the MACD. And what, as traders, we're looking for is the crossover, the moment where that brown MACD line crosses the black, or crosses back above the black. And so as this shifts higher and lower, you're getting your buy and sell signals. And there's a whole school of traders that will lean upon this MACD indicator to help them make their trading decisions. And I can't say help them. It shouldn't be your sole driver of your decision, but it is certainly one of the things that a lot of beginners lack is often the confidence to act upon their conviction. And what usually a technical indicator does is it's like a little nudge. It says, yeah, you're bullish, and now the MACD is also bullish. Maybe you should actually act. It actually helps emotionally a lot of traders take the conviction of acting upon their ideas. So let's move on to the RSI, or relative strength. And the relative strength index is used also as a momentum oscillator. Now, what the relative strength does is it compares the magnitude of the stock's recent gains versus the magnitude of its recent losses based upon a certain sample size of a certain number of days. And so what's trying to do is gauge what is the relative strength of the price action over the setup period of time. Now, what traders have now done is turn that into the signal that identifies overbought and oversold conditions. And the standard overbought, oversold levels on the oscillator are set to the 30 and the 70 level. And so there are traders that will, during a bull market, set it to like 80-40, or during a bear market they will set it to 60-20 to identify the fact that the general level of the RSI will shift based upon major trends. And if you're trying to identify extremely overbought or oversold conditions, the RSI, you want to be able to identify that. But with that said, let's just actually show an example of it, because I think that's where you'll get a good grasp of this. So what I wanted to just highlight is some different periods. When you're using the platform, what you will find is that often they will default usually a 9-period or a 14-period default, which is basically saying what is the relative strength been over the last 9 days, what's the relative strength been over the last 14 days. At the same time, you could speed that up. There are traders that love to anchor themselves on a very rapid moving 5-period RSI, and other traders that like to slow the RSI right down. They only want major turning points, major periods where the market is incredibly overbought or incredibly oversold, and therefore they want, by adding a larger sample size, it's harder for the price to get overbought, oversold without there being a significant market push to do that. So using the 14-period default setting, I wanted to just simply circle the buy signals, and then in the next slide we'll look at the sell signals. The point I want to illustrate is notice that each time that RSI was trading below the 30 line, it corresponded with a period where the market was in fact quite oversold and trading at the bottom end of its range. Now, the debate by many technicians is what is the action point that actually determines that you turn around and buy at one of these moments. A lot of traders, what they'll do is wait for a closing price above the 30 RSI as their signal point. So like in that early part on the left, where you see that it stayed for an entire month below the 30 line, it was only when it broke above the 30 line that the signal to buy actually occurred. And nonetheless, what you can observe is that the RSI did a pretty good job at identifying those oversold conditions that led to those buy on dip opportunities. Now, to look at it from an overbought perspective, on that same chart, recognize that when you're using the 70 line on the upper zone, notice how each time that RSI approached the upper boundary, that under each of those circumstances, you had an overbought condition significantly enough that actually caused some form of a market correction to ensue. There's a few places that it didn't sell off very long, but generally you can see how an overbought RSI was a very respectable level from which to potentially act upon your idea in terms of taking profits or hedging it or doing some other type of an action. So, and nonetheless, the RSI, very interesting tool for identifying those overbought and oversold indicators. Now, I want to go to the fastest reacting indicator out there, and it's known as the stochastics. So let's really dive into understanding what the stochastics are and how they work. So stochastics show the location of the relative close, the close relative to the high-low range of a set period. And so what we're doing is, let's say over this period, a stock is traded as low as $10 and as high as $14. If the closing price is 13 and the highest and the lowest of trade is 10 and 14, the stochastic is gauging where the price is within that range. Obviously, by continuously dropping one data point and adding a new one, the stochastic is dynamically changing as time periods pass. And you obviously, it follows the speed and the momentum of the price. It is actually very rapid to respond. So what do I mean by that? Let's actually take a look. But before we do, we're going to just grasp a couple of the core understanding of the settings that are used in stochastic. So the main stochastic indicator is known as the percentage K. And the percentage K is the range of the underlying security divided by its close minus the low. And so this is the way the percentage K oscillates within that. Now, the percentage D, very similar to the MACD, is the signal line. It's a moving average that is a moving average of the percentage K. And so what we're getting here is essentially a signal line that is crossing. Now, I'll give a perfect example of this. But what we're going to suggest here is that the most common metrics from which traders use is the 13-period percentage K and the 3-period percentage D. So what that looks like when we put on a chart is you can see here that when I have this chart of the security, that the percentage K looks no different than an RSI or no different than the initial MACD line. But it actually mathematically is computing a different way. Now, what we're going to do is overlay a moving average on top of that. So notice here that we have, in this case, a 3-period average on the main percentage K line. What this is now showing you is a variant amount of buy and sell signals that emerge. And so as we can see here, what you're trying to identify is some of those key turn points and when they give you a signal. Now, what is the one characteristic of why I keep saying it's the fastest signal? Well, think of it this way. If the indicator is measuring the lowest the price traded and the highest the price traded, and it's looking at where the relative closes within that range, the moment in the, let's say at the bottom over here, circled in green, that price reverses off of that low in that range, the stochastic mathematically immediately has to shoot higher. It's just the math in the stochastic. And so it is incredibly fast in its response. Now, there is a catch to that. While having a very fast response ensures that you are in early if you are right, but what we often find is that a signal line, because it's so fast, often can get faked out. And this is where stochastics with a secondary indicator like a MACD is a very popular way of combining the two to have two indicators confirming each other. Also, the other observation to make, which I always like to observe, is the fact that as soon as, let's say, we're measuring 14 days, as soon as the stochastic is trading at a 14-day high or a low, the stochastic gets pinned at that high or low perpetually, and because it's always dropping one data point and adding a new one, and it's a process from which that is developing. Nonetheless, stochastic is one of the ways that many traders look to get very quick responses in their trades in terms of a technical signal. So this is where I want to finally talk about the last indicator, which is momentum, and also known as MOM. So what exactly is this momentum indicator? It's known as a leading indicator because, again, divergences in momentum often can take place before the price starts to move. And so a momentum indicator measures the rate of change in the underlying security. And the oscillator compares the current price with the previous price of a designated level. And so the easiest thing to do is actually just have a quick look at one of these. What we're looking for, though, when we're actually looking at a momentum oscillator, is we're looking for bullish and bearish interpretations that are found by looking at those divergences and the centerline crossovers of extreme readings, very similar to what we look for even in the MACD and RSI. And so, but let's actually gauge what's going on here. Now, notice here what we use with a momentum oscillator is trying to identify those periods where the price has sustained price action, let's say above the zero line versus below the zero line. And so what you can see is that during the first, I marked off two zones with the red lines. So if we're looking at the first zone to the left, we can identify that even though there were two very short-term spurts, the majority of that time, the momentum stayed below the zero line. Similarly, during the entire bull advance from early January all the way through to April, as this was rallying, you had the RSI stay decisively above zero all the way through the trend. And so this year is just a really interesting way for us to be able to gauge that what is the primary trend. Am I actually trading in the direction trend? Sometimes the biggest money is in trading in the prevailing trend direction that's been established, and this gives you something from which to gauge it, and then find trades that allow you to participate within it. And so this is where I want to just show you where traders use divergences as an indicator. So notice here in the final part of the right, going up to the first red arrow from top to bottom, you can see that we had this security drop from 63 bucks to a low of 51. And so you had a scenario where it was an incredibly ugly sell-off. And subsequently, you had a bounce. And after the bounce, it immediately sold off again. Now, the interesting part about this is that notice that while the price did retest the lows, and in fact, if someone had stop losses down there, or the point being here is that it came back down, retested the lows, but has ultimately established its base and used the base from which to launch a new advance higher. And so identifying when the divergent momentum, notice that momentum at the bottom, as a double bottom retested the low, the momentum not only did not break down to the red arrow, stopped at the green arrow, but then the moment the first green candle popped, the moment that happened, everyone's rushing in to chase this security. And so this continues to be an interesting way of observing a divergence within that process. So just some conclusions to leave you with on all of this. Technical analysis is incredibly valuable because it bridges the gap between fundamentals and the real market. The real market is fraught with psychology. It's fraught with order flows and all sorts of other variables that are driving the price volatility. And much of that liquidity whipping has very little to do with fundamentals. The fundamentals are an anchor, but the liquidity is driving the volatility. And so that is so important to incorporate the technical analysis with your trading, because it allows you to bridge that price action with your trade. So the final conclusion: indicators are just mathematical interpretations of price action. Therefore, there's a redundancy to use too many of them. The temptation when you look at your brokerage account and realize in the charting segment there's 15 or 20 or 50 different indicators available to you, immediately you're thinking, oh my God, that's overwhelming, right? Like I don't know what am I supposed to do? And so what we try to do here is isolate some of the more popular ones and give all of you enough confidence to just pull up some of these charts and look at some of these to see whether or not the charts you're looking at and the way you're looking at it actually makes sense. And it's just such an important, valuable thing to learn to do. So for part 5, when we get to it, it'll be about creating a trade plan. It's about how do you stay disciplined throughout this entire process. And that's something that I look forward to taking you with in the coming months. But that it'll be the last part of the 5-part series. So thank you very much, everyone, for joining me. Again, my name is Patrick Ceresna. I'm from Big Picture Trading. You can follow me on Twitter at Patrick Ceresna, and make sure you turn around and listen to our free podcasts and YouTube shows of Macro Voices in the Market Huddle. And visit the website as well at bigpicturetrading.com. Nonetheless, thank you very much, and hope you enjoy the rest of your day.
Thank you so much, Patrick. We really did appreciate that. And now on to questions.